Your resource for financial direction during turbulent times is America's Financial Headquarters.
There's been a lot of controversy over Mitt Romney's 14.1% tax rate that he paid. A lot of the news has been out there, and there's a lot of kind of riffraff back and forth as to is it enough, is it not enough, and all that good stuff. And we're going to get into a discussion in a little bit about how he did it and strategies that you as the American consumer can take to reduce your tax rate. But
yeah, that's actually really good news for everybody.
Yeah, absolutely.
That he was able to have 14.1, that's a great opportunity for all of us.
Absolutely. But the believe it or not is there is one president, if you look at the past 8 presidents since 1970,
past 8 plus Romney.
Plus
total
Romney,
9,
the nominee.
9 guys.
Yep. If you look at them, there is one president that paid considerably less than Mitt Romney.
Less than 1%.
Do you think you know who it is? Let's kind of rattle through. Let's go back. We'll kind of start at the high end and come down. For our Michigan stations that just came online, the highest, if you looked at the last 8 presidents, was Gerald R. Ford, right there in Grand Rapids, Michigan, paid 37.8%.
Now keep in mind that the marginal tax rates has varied dramatically over these time frames.
Right.
So back in the 60s into the 70s, even into the 80s to a certain degree, the marginal tax rate was north of 70%.
Yeah, the top marginal tax rate. You're right. 60, 70%, and it has trickled down since then. So that is going to factor in. So don't read into these stats too much, but they are kind of fun to look at. Number 8 was Ronald Reagan at just over 32%. Number 7 was Jimmy Carter, who came in at 31%. Number 6 was George W. Bush, who came in at 27%.
Can I pause you right there?
Sure.
Because the other thing that's kind of interesting when you look at this series, you just mentioned Ronald Reagan. Ronald Reagan was our first presidential challenger who was pressured to release his taxes.
Correct.
So, if you recall the last couple of elections, that's a huge deal. And everybody wants to pressure for, releasing of taxes. Obama's getting pressured because he's not coming up with his college transcripts, all this different stuff. Mm-hmm. The pressure, the first time that really happened was in the Ronald Reagan era. He was the first one to release those.
Right. Now, the next one on the list is our current sitting president, Barack Obama, who came in at 26.5% or so. Then there was Bill Clinton, who came in at 20%. Number 3 was President George Herbert Walker Bush, who came in at 19.86%. Number 2 on this list of 9 is Governor Mitt Romney, who is sitting at 14.1%. That's obviously been the big news. We're going to discuss a little bit about how he got there and strategies that everybody can take on.
And a lot of these presidents use the exact same strategies, just maybe not to the same degree and or in the same tax brackets that.
Right. For those of you that are just plugging in and tuning in here, we're going through a believe it or not and sharing with listeners the one president over the past 40 years since 1970 who had the lowest effective tax bracket. And we're about to unveil. Mike, I'll let you do the honors.
Less than 1%, actually coming in at 0.3%. Can you imagine?
That's not a misstatement.
Yeah. Can you imagine paying 0.3% on your taxes?
Mm-hmm.
Sign me up.
Mm-hmm. Well, for those of you that have been paying attention, who is it?
So Tricky Dick.
Yep, absolutely.
President Nixon, thanks to the fact that he had gifted into the National Archives his personal papers, and he had done so much gifting, and much to his continued demise after Watergate and everything else, turns out those papers were overvalued.
Right.
And so then he came back and actually had to pay more tax to make up for the overvaluation of the value of the gift that he had released. So the end result is he probably paid a little bit more than that, but he was still extremely low. And it did come in at less than 1%. Actually came in at 0.3% for his tax payments in that time frame. Yeah, it is startling. But the real thing is, what's the takeaway?
Right.
How do you, as a personal investor, how do you, as someone who's earning a living today, whether you're during your working years or enjoying your after work years, how are you going to take what, some of these presidents have taken advantage of? How do you do that for yourself? And what, it really kind of boils down to two main categories. Number one is capital gains income versus personal wage income.
Correct.
And number two is strategic gifting.
Yep.
Gifting comes in two forms. It comes from the heart, but it also comes from the pocketbook. And there are good reasons to gift that have nothing to do with anything financial. And there are great reasons to gift that also have some strong ties to financial. Sure. And if you can combine those two things together, that's a home run.
One of the things I think that's been it's been on the radar a lot in the news is this fiscal cliff that we're facing. And Romney came out in the second presidential debate and kind of laid out, he might have been the only one that's truly laid out his financial, proposal that he's putting out there. And if you listen to this, there might be good news for a lot of us that are sitting out there.
Every middle-income taxpayer no longer will pay any tax on interest, dividends, or capital gains. No tax on your savings. That makes life a lot easier.
Not only does it make life a lot easier, but it helps get money off the sidelines. It helps get people and business to start investing. Sure. and to realize that those investment dollars are important because, since the crisis, the personal savings rate has about doubled. But people are hanging on to that money. So, if you wanted to find one good thing about the side effects of the crisis, that would probably be it. Some people started to rein in their debt. Some people started to actually hang on to some money and tuck it away and start to hold it and invest it and save on it because you're paying taxes, on your savings accounts. You're paying taxes on your CDs. You're paying taxes on your equity and your stock investments and your mutual funds and so on and so forth. And so for Mitt Romney to state, that steadfastly that he wants to eliminate that altogether, that could be huge for people.
Let's talk a little bit, Mike, about a charitable giving tool. I know that you had kind of referenced a moment ago one of the ways that a consumer can reduce their tax bracket and ultimately their effective tax rate is to handle their giving a little bit differently and how it is that they might go about that deduction. And we wanted to briefly introduce the Donor Advised Fund. Touch on that real quick as to what that is.
Yeah, I would encourage people to take literally just the few minutes that is required to set up a donor advised fund. And we'll have hanging out on the website some downloadable material that'll help educate people on that. But really, it's as simple as setting up a bank account. So you open up a donor advised account. We tend to do a lot of work with a group called National Christian Foundation, but there are other donor advised locations as well that are more secular. But essentially all you're doing is you're setting up a donor advised account so that now you can gift into that. You get the deduction immediately, whether it's cash, stock, or assets. You gift into that account, you get the deduction immediately, but now you can take your time to decide where do you want that money to go. So for example, right now, based on the current calendar year, things are really ramping up for donor advised funds because people are starting to put their money in. They want it in there before the end of the year, even though they might take even years in some instances to decide where they ultimately want that to go. But you can take some examples of how to do that so strategically. So rather than gifting cash and just gifting it as is, you could take advantage of gifting a highly appreciated stock. Gift that in, eliminate the capital gains taxes on that altogether, and then the cash that you normally would have gifted, turn around and rebuy that stock at today's rate, and you've just reset and upticked your cost basis.
Absolutely. And I think that's one little strategic tax move that people can change in terms of their giving that can alter their effective tax bracket. It can put them in a better financial position, keep them essentially owning the exact. If they love the investments they own, they can continue to own those. Yet they're going to make that change.
Yeah, and you can get a report and some data off of financialhq.com. Just go on there, download it. It'll tell you all about how a DAF, how a donor advised fund works.